Hey, good people, it is your girl, Indigo Metellus, here in North Carolina, your favorite realtor. And this is day 4 of the legacy building series that I have started this week. If you were not able to join in this week, make sure that you catch those replays on the legacy building series that we started. We started on Monday with leverage. On Tuesday, we talked about my brain just froze for a second. We talked about reduction, debt reduction. On yesterday, we talked about supply and demand and the market and its supply and the demand from the buyers to buy properties now. And today we're talking about the tax benefits of real estate. So if you're just tuning in and you don't know who your girl is, let me go ahead, give me 1 second to get us in here, to get us started, good people. I just want to go ahead and start doing a little bit of sharing, and once we get it shared out, so we can go ahead and get this good information, doing a little late start for tonight, but it is okay, because I hope that you had a fabulous day. I hope that you were able to be your best and get your best and get everything that you desired and wanted for yourself. And today, we are going to be talking about, give me 1 second. We're going to be talking about the benefits, tax benefits in real estate. So I'm going to go ahead and share a little bit, and then we're going to go ahead and get started on this good information that we have for you good people for today. So just give me 1 hot second, get this information shared, and there we go. Okay, we got it shared. So if you're just tuning in, my name is Indigo Metellus, and I am a realtor here in Greenville, North Carolina. Just want to throw it out. I'm accepting new clients and all referrals. So if you know anybody that is ready to purchase or list a home here in North Carolina, let me know, because I am with one of the greatest real estate firms, the Avalon Realty group here in North Carolina. And we have people all over North Carolina that can assess and help you with your real estate needs on demand. Okay, so I'm Indigo Metellus, and we're going to go ahead and dive into this information regarding the tax benefits or tax advantages in real estate. So owning your own real estate offers a number of benefits. It's hard to beat the tax advantages when you are real estate investing, right? So there are 5 things that I wanted to bring to your attention as far as benefits that can help investors that are ready to invest and build their legacy in real estate. So one of the tax benefits that we have right here, we have deductions. Now, there are certain things in real estate that you are able to deduct that are real estate invested. Now, also, let me throw out as a disclaimer, I am a real estate agent, realtor. That is my lane. This information that I am giving to you, that I am helping you out with, is information based off of real estate, which is my lane. Now, if you want more financial information, I would advise you to talk to your CPA or your financial advisor regarding any more further details regarding the finances of real estate. But my lane is a realtor, so I'm going to give you information regarding real estate. Okay, so number 1 on our tax benefit is deductions in real estate. So there are things that when you invest into real estate property, rental property, that you can deduct. Such things such as property tax, property insurance, mortgage interest, property mortgage fees, property management fees, property repairs, capital improvements, ongoing maintenance, advertising expenses like the cost to rent your rental, put it on the market to sell your investment property. So these are some of the things that you can use. And on Tuesday, we talked about the commercial loan that you can get when you have a business, an LLC. So a lot of these tax advantages is really based off of a person that is really investing into properties and using their business. They have a business name. It can even be your last name, LLC. Metellus LLC, Metellus Real Estate LLC. And all you're doing during that business is you're running your property, you're running your investments through that business. And there are tax incentives that you can receive because it is not a property that you rent for yourself, or sorry, not rent because it's your property, but it's not a property that you live in. It's a property that you're renting out, even for Airbnb, using those costs, the cost of certain items that you can purchase for the home to run the business of the Airbnb, the taxes that you can spend on that. There are deduction costs. Now, those actual costs, you want to definitely make sure you're talking to your CPA or your financial advisor so they can give you even more sound information. But as the first tax advantage is the deductions when you're running a rental property or running that investment property through your business. And we said property tax, property insurance, mortgage expenses, property repairs, advertisement expenses that you use to advertise the home in the ads on Facebook, Instagram. When you are listing the property for sale, you can also deduct those as costs to the business. Marketing and advertisement expenses such as mailers to mail off marketing leads, business cards, or signs for your office. Legal and professional fees such as the accountant, the attorney, and bookkeeper. Those are fees that you can also deduct. Business equipment such as laptop, printer, office desk, and phones. Office space if you have an office space, including home space. Now, there is a paper or a certain percentage that you are allowed to write off as your home office, as long as it's the home off, as long as your home office is being predominantly used for your business. You can also write off things or deduct things such as internet is being used for the business, P.O. boxes, phone lines, travel expenses, including vehicle mileage and parking fees, like tolls that you have to use to cross different counties if it's regarding the investment or looking for investments for your business, because you're coming into real estate, you're building up your legacy building, not just to buy a home for you and your family, because you're looking forward to purchasing properties that will generate income, passive income. So these are the tax breaks that you can get because you're running a business through your LLC. And so therefore, these are benefits that you are able to deduct. Also, education and membership fees, annual fees. If there's any fees that you may, or classes that you may be taking, within the next couple of weeks, I will be dropping my home buying course. And those are things, education programs that you can drop, especially as a realtor. We are a part of MLSs. We are a part of we're part of MLSs and Realtor Association, so we can include those memberships. And as far as an investor, if you decide to be a part of an investment group that charges membership fees and has courses for you to learn how to flip homes, courses on how to wholesale, classes on how to run Airbnbs, those are educational classes that you can also write off as a deductible for the business. Okay, meals that you're having with prospective clients or current clients. Maybe you're about to have somebody rent out the home, or you're going to have a property management rent your home for you, and that is a meal that you can write off. Most of the property related expenses can be deducted at face value, although some, like capital improvements, are depreciated over a period of time. Many business deductions are a portion of expenses. For example, you can only deduct 50% of your meal expense or $5 per square foot of your home with a maximum of 300 square foot. So if you're basically with that saying, and make sure you check with a CPA to make sure you're getting the correct information. But like it said, $5 per square foot of your home office or a maximum of 300 square foot, you are allowed to write off on your taxes as a deductible, as a benefit, okay? Make sure that you keep good records. Make sure you're writing down your mileage. Make sure you're keeping your receipts of things that you're buying. Make sure that you are labeling these things and putting it up. The better your records are, the better that if anything comes up with the IRS and they need to check those records, you have everything. You don't have anything to worry about because you kept good records. Another tax benefit is depreciation. Now, owning property that is being used for a business or income producing purposes like a rental property for a year or more, you can depreciate the cost of the property over time. Depreciation is the method of deducting the property loss in value over the expected life, which for residential properties is 27.5 years and commercial property is 39 years. In essence, it's accounting for a decrease in value for average use and wear and tear. So when you get into the depreciation, definitely this is the time to call in that realtor so that they can make sure that they are helping you do that math for the depreciation. But an example that I have for you is if you purchase a single family rental for $200,000, you can deduct an annual depreciation of $7,222 each year because you are taking $200,000 divided over 27.5 years. You can also depreciate certain capital expenses like replacing a roof or installing a new HVAC system over a period of years. This can help provide even greater depreciation deduction on your annual taxes. Depreciation can only be used on investment properties. So if this is a home that you have purchased as a rental property, an Airbnb property, an office space, this is when you are able to depreciate and use it as a tax benefit. Like we said, property is 27.5 years for depreciation, residential property that is, and for commercial property is 39 years that you are able to depreciate over the property loss in value over its expected lifespan, right? Now, depreciation can be used on investment properties, like I said, making it a huge tax benefit available only to real estate investors. A lot of investors get into this game because of not only the passive income that they can make, but also the value of the deduction and depreciation, okay? Now, depreciation does not last forever. When the property is sold, depreciation is recaptured. The depreciation amount is then regained and taxed as an ordinary income with a maximum tax rate of 25%. There are methods to avoid when depreciation recaps, like the 1031 exchange. Remember, I am a realtor, just giving you the information regarding tax benefits when you're buying real estate investment property. But if you want to know more of the financial accuracy, definitely consult your accountant, your CPA, or your financial advisor. Sorry, my mind just went blank a little bit there. So the third thing on how you can maximize tax benefits is passive income passing through deduction. Okay, real estate has the ability to produce passive income. It has a cash flow. We're going to talk about that tomorrow. So hopefully you're able to join me tomorrow to talk about the cash flow aspect of real estate. So the cash flow that is earned without having a continued work for it. Passive income is often confused with passively activity. Okay, so here's a term for you. Here's a term for you if you are that type of person and just need terms. So according to the IRS, passive income is any money that is earned from a rental activity or a business activity in which they do not materially participate in, yet is explicitly excludes residential income earned from a passive investment such as dividends or interest from a mortgage note. That means passive income in real estate is commonly earned from rental income. So you buy a home, you put someone in your home, you are passively earning income. There is a tenant living in your home, you have an Airbnb, you're renting out a room, you are passively earning income according to the term that the IRS defines as passive income. Okay? So, let's see. Go. So, if you're collecting passive income, then it allows businesses who earn qualified business income, QBI, which includes rental income, to pass up to 20% of the taxable income using a pass-through deduction. Okay, it's important to know that you can only take advantage of this pass-through deduction if your business is profitable and is not all income types qualify for this deduction. It is currently available into 2025. So this, I believe, came after 2018. So we have about 4 more years to be able to use this qualified business income, meaning that it's income that passes through your business, income that you're collecting from your tenants. Okay? So the fourth tax benefit that we have for you is capital gain tax instead of income tax. When you sell a property for more than you originally purchased it for, the profit will be taxed at a short-term or long-term capital gain, which is typically a lower tax rate than ordinary income taxes. Short-term capital gain, which are properties held 1 year or less, can range from 10 to 37% depending on your income bracket. Long-term capital gain, which are properties that are held a year or 1 day or more, are taxed more favorable, ranging from 0 to 20% depending on the tax bracket. So the longer you hold on to the property, the less taxes you have to pay, which is a long-term capital gain. The shorter you hold on to the property, the more you have to pay on the taxes, which is 10 to 37%. And it all depends on your income bracket, like everything else, right? So you can utilize tax-deferred or tax-free methods on investing in real estate to avoid paying capital gains. So, and then number 5 benefit of tax benefit for real estate. So we just talked about the tax-deferred and the tax-free method. So invest, tax-deferred, or tax-free method is utilizing the 1031 exchange. Now, this section 1031 in the IRS tax code, that is why it's named 1031. The 1031 exchange is a legal transaction that allows real estate investors to swap an investment property for a like-kind property therefore avoiding capital gain and depreciation recap on the sale of the property. So basically, you're getting another property that's similar to your property. And I think this method may be more used when you are flipping homes, especially if, and that would be a short-term gain, because you're hoping, your goal as a flipper is to get rid of that property within 90 days. You get everything together in, I would say 90 days or less, because you have to make sure you allocate 30 to 45 days for the lending process if you're going to go with a buyer that has a lender. And then also the amount of time that it takes to get that home ready to get it to market, depending on the repairs that need to be done, that you're also using as a tax benefit, the repairs for that home. So if you buy that property and you get rid of that and buy another property, that is a 1031 exchange. Now, a tax-free or tax-deferred retirement account, there are special savings accounts like health saving account, a HSA, or a special individual retirement account like an IRA. And this is really when you want to start talking to your financial advisor and accountant on the different accounts that you should be able to go into if you're not interested in buying another property for that swap in the example of the 1031 exchange, to avoid those depreciation recaptures or avoiding the capital gains. So the other accounts that you can use, I said the IRA is like a solo 401k or a self-directed IRA that allows you to invest in alternative assets, including real estate, tax-free or defer. So these types of account you open, there are different requirements prohibiting whom and what you can invest in each account. But the point of it is, it's a great way to help you avoid taxes but still invest in real estate. Okay. So I'm just going over my notes to make sure that I kind of got to you guys a lot of the information I wanted to give to you. And I know that it was a lot of information that I'm giving to you, and I wanted to make sure that you understand the different benefits that you have when it comes to the tax benefits. So I didn't even talk about such things as the bonus depreciation in section 179 depreciation. This allows you, if you're eligible, to deduct expenses right away in the year in which you're purchasing and is put into service. Bonus depreciation uses only 50% and then is bumped up to 100%. So that is a whole another thing. It's supposed to start in 2023. The bonus depreciation, they're saying it's supposed to go down 20% each year until entirely is off the table in 2027. So that is another benefit for you investors that are out here to look into section 179 deductions. Talk to your CPA about that so they can give you thorough information regarding that. And then we also have the no payroll FICA tax on rental income. So it's a tax on employees and employers that fund Social Security and Medicaid. FICA is known as payroll tax because it comes out of people's salary. If you're self-employed, your FICA tax contribution is 15.3%. However, you don't pay FICA tax on rental income, which is a significant saving. If your rental income is $100,000 per year, not paying FICA taxes saves you $15,300. So these are some other tax benefits that you don't have to worry about paying. You don't have to worry about paying taxes on cash out refinance money. Refinancing is when you get a new loan with more accommodating terms than your old loan. Cash out refinancing is when you get a loan for more than your debt value. These funds can be used however you want, and the money is not taxed. So the make this popular investment strategy like BRRR, it stands for buy, rehab, rent, refinance, repeat. It's exactly what it sounds like. You buy a property, you rehab it, you rent it, you refinance it, and then you use the money from the cash out refinance plus whatever you stand to repeat in the process. So I'm going to say it one more time. It's the BRRR, which stands for buy, rehab, rent, refinance, and repeat. You don't have to pay taxes on this because you already refinanced the loan. So it's basically you rehab the property, you renting it out, and you're getting it refinanced. So what that does is you go to the bank, you let them know, hey, I have a property, I own it, I want to get it refinanced, and I want to know what the appraisal value of that home is. The bank sends out an appraiser. The appraisal takes the comps of that neighborhood. They come back to the bank. They let them know, hey, the person bought this home straight out for $30,000, even though you may have put in $20,000. So now it's $50,000 that you went all in debt into this home. You're renting it out. Now you got it refinanced because of the comps in the neighborhood. Maybe there's homes that have sold for $110, and now the appraisal came back. Your $50,000 home that you invest and put your money in is now worth $110, and you refinanced it with a loan to get a loan, and now you took that money that you got from that refinancing of that home, and you took it and you went and did the same thing. Another BRRR, bought or buy, rehab, rent, refinance, and repeat. So another way tax benefit is BURL. It stands for buy, utility, rent, luxury. The appropriate strategy, you need to know how the cap rate works. Cap rate is the measurement of how long it takes for a property to pay for itself and begin to make a profit, a profit expressed as a percentage. A low cap rate is considered low risk because it is less likely to stop generating income, while a high cap rate is considered riskier because it's more likely to stop generating income. So the idea behind BURL is that you buy utilities because it has a lower cap rate. So you can afford to rent a luxury place because it has a higher cap rate. Now, why would you do that? Because the luxury property could experience greater appreciation over time, making it worth the risk. Another tax benefit is a live-in flip. There's a show right now on HGTV where there's two gentlemen. They actually purchased the home, and I think it's in the series out of Detroit, Michigan. So basically, what they're doing, they buy the home, they live in the home while they're fixing it themselves, and then once they get it ready to market with their realtor, their team of realtors, and I think they have two different realtors that they use. After they have renovated that home, while they're living in it, they flip it and then they get it to market. So flipping and rehabbing is not the same, but the live-in flip investment strategy exists somewhere between the two. You could end up paying zero capital tax on a property that earns upward to $250,000 for a single filer and $500,000 for a married couple filing jointly. It qualifies for Section 121 exclusion, which means you have to live in the property and it must be your primary residence. You have to own the property. You have to live in it for 2 out of the 5 years that precedes the sale. So this is what it looks like when you live in it. So it's similar to that show, but not quite, because they don't live in it for 2 out of 5 years that they plan on having the property. They actually live in it, and then they sell it and they get rid of it. But what it means is you will live in a house while adding improvements that add value to your property. Your changes can even be made with easy rental turnover management and attracting high quality tenants. You just have to be able to live in that home while it's undergoing repairs. So a great way to acquire an investment property, to do the live-in flip, to use it as a tax benefit, is if you get a duplex. You're living in one side, you're fixing it up, you have another side, you're fixing that up. You can bring in a tenant, earn income on that duplex side while you're living in the other side and getting the tax break of renovating your side of the house and fixing it up. And you only have to stay there for 2 out of the 5 years of owning the house, and you get that tax break right there. If you attempt to live in the flip, but something comes up that requires you to move out before you live there for 2 years, you still can qualify for partial exclusion from capital gain tax, depending on the reason why you're moving from the home. And the reasons have to be such as job relocation, change in health, military deployment, and unforeseen circumstances. So I hope that you have enjoyed the conversation that we had today, and I'm going to throw it out there one more time. Make sure the greatest tax benefit out of real estate is talking to a CPA that is maybe more qualified in tax or real estate law, and that therefore they can answer more of your questions. Therefore they can help you, guide you, and be able to help lead you to the right information, so that way you can take all the opportunity on and get all the tax breaks regarding your real estate investment. So I hope you had the opportunity to enjoy our series today, our day 4 in the legacy building series, which was tax benefits. Make sure you catch the replays of leverage from Monday, debt reduction from Tuesday, and Wednesday we talked about supply and demand. Today we talked about tax benefits, and tomorrow we will be wrapping up the series with cash flow. Also, just to put the information out there so that you keep it fresh in your mind, on July 29th, I will be doing my free webinar, 7 Proven Ways to Generate Wealth and Build Legacy Through Real Estate. It's a free webinar, and it will be 7 p.m. Eastern Time here on Instagram and on Facebook Live. So once again, join me July 29th. Go ahead. I'm going to drop the link down for you to go ahead and sign up for that free webinar that I'm having on July 29th at 7 p.m. on Instagram or Facebook. So look out for it. Or actually, I'll be sending you the link once you sign up. So it won't be on Instagram or Facebook. I'll be sending you the link out. So sign up so I can send you that link, and we will be ready to go on July 29th for the 7 Proven Ways to generate wealth and build legacy through real estate. I am your favorite realtor here in Greenville, North Carolina, Indigo Metellus. If you want to connect with me and schedule a consultation, please feel free to click on the link that is in my bio in the Instagram, and I would drop the link here on Facebook. But definitely reach out to me so we can connect and get you ready to be sold.